Good afternoon, everyone. You're joining the Town Hall Tuesday, the One Investment. I'm Fernanda, and I'll be monitoring the webinar. And here to present One Investment is Keith Taylor, and I'll let him take it away.
Yes, hi, my name is Keith Taylor. I'm a CFA. Just to give you a little bit of background on myself before we start, I joined One Investment in the last few months as an investment manager. I am a CFA. I was hired to provide investment advice to the municipalities in Ontario, and also to be one of the builders of our Prudent Investor solution offering, which I will go through in a few minutes. I've got over 20 years of experience. I've managed mutual funds and ETFs. I've advised individual investors. I've advised institutional investors. I've done active and passive and bonds and equity. I have a broad scope of experience, including a great deal of experience putting all the pieces together into investment mandates, which is one of the reasons I was brought on board. So I'll briefly give an introduction to One Investment, and then go into greater details on the Prudent Investor solution that we are bringing together. One Investment, I will presume that there's some level of understanding of who we are, but just briefly, we are a new non-for-profit organization, and our purpose is to directly serve the Ontario municipal sector. There is some history here. The One Investment was organized as a program and has been in existence for about 25 years. It's sponsored by LAS, which is a subsidiary of the AMO. It's also sponsored by CHUMS, which is a subsidiary of the MFOA. It was operated as a program of these organizations. In the last year, we changed the structure a bit. We turned it into its own non-for-profit organization. So it's got some level of independence. And the reason we did that was so that we could change the offering that we can give to municipalities for the Prudent Investor standard. Specifically, we needed some exemptions from the Ontario Security Commission to allow us to basically trade on behalf of clients and give advice. And this new nonprofit structure was set up last year to do so. Our role is basically to provide investment advice and investment services to the likes of the folks on this call. We have 165 municipalities participating so far. That's with 444 municipalities in Ontario. That's exactly 37% of all municipalities that have some investments with us. The next slide will just show you who are the folks that are investing with One Investment. We have a clear bias towards smaller municipalities. In fact, about 70% of the investors within One Investment are municipalities with population of 25,000 or less. That is something that we are aware of, and that directs what we do. We do have larger municipalities involved also, but we think that the value add is going to be more relevant for the smaller communities where the access to financial services and financial advice might be more limited just because of the scale of the municipality. I will note that some of the large municipalities, they do represent a larger portion of our overall funds under management, but in terms of membership of municipalities represented, the smaller ones are the lion's share. This slide gives you a snapshot of the investments that are with One Investment, the money that's in our programs, and it shows how it was last year, at the end of last year. Sorry, at March 31st, 2018 versus the March 31st this year. Broadly speaking, our largest product is a high interest savings plan, acronym HISA, which had roughly $700 million at the end of the first quarter. And this shows you the other mandates that we have in terms of the asset growth. At the end of the last March 31st, it was roughly $1.6 billion in assets in total. Because the monies in HISA can change from day to day, the balance actually has increased by a couple $100 million since that snapshot was taken. Now, here is a description of the products we have available under the legal list. The HEAS account, the high interest savings plan, is one of our biggest products. This is something that's administered by One Investment, and CIBC is the underlying vendor. They provide us the investment side. And this is like a bank account. The money goes in and comes out very quickly. It's like you could use it like any other bank account. Because there's a large sum of money available in this pool, and we are able to negotiate a rate for investors that in many cases is higher than they might be able to get at their local financial institution. The current rates are 2.145%. You know, for what is effectively overnight money, is actually quite respectable. We have a number of other investment products that are pooled investment products to give diversified exposure to different investment classes. The short-term government bond, that is managed by an outside company, MFS. It is exactly what it says. Invest in federal and provincial and municipal government bonds. Very high credit quality bonds are in this, and relatively short maturity for the securities in this portfolio. It should, in theory, give higher returns versus shorter-term money market or HISA deposits. And then the next product in that realm is, it starts with that base of high-quality government bonds, and then adds to the mix some corporate credit instruments in there. Typically 50% or more of the portfolio is in non-government bonds, which allows it's slightly lower credit quality, which means slightly better returns. It's also managed by an external fund manager, MFS. And lastly, the Canadian equity mandate, which is managed by a firm, Guardian Capital. It invests in Canadian equities. It's specifically designed to be less volatile than the TSX index, and it's one of the only ways, it is the only way effectively right now for the municipal sector to invest in equities. Now, we always recommend that what you put in your, how you invest the municipal funds should be reflective of the needs. And we will note that for investment products like these, there's a time frame you have to keep in mind. Well, like the example being equity. As we all know, equities can be more volatile, and therefore, if you don't have the stomach to deal with that volatility, you probably shouldn't be there. Or another way of putting it is, if you have a long time to recover from any losses, it makes it more appropriate. So if you are wanting to park your money for a short period of time, equity is not the way to go. If it's going to be parked for a much longer period of time, it's likely that it will be more appropriate. As a slide here, you can see there's one column, intended investment duration. That gives the hint. The more risk you add into the product, the more volatility is involved, and therefore necessarily we would advise only investing monies that are not required urgently. I will now start discussing a little bit about the Prudent Investor standards and how we're approaching it. The Municipal Act dictates what municipalities are allowed to invest in. It is a very narrow subset of the investment world. It is basically constrained to only Canadian securities of one sort or the other, and is very prescriptive within there as to what can be invested. It's a very narrow subset. The Prudent Investor world does not have those same sort of handcuffs in terms of where money can be invested. It opens up a huge realm of other options that might be available to investors, which potentially could provide better returns. But more importantly, because the investment vehicles are different and have different risks, they tend to provide diversification. Basically, You have having more choices out there allows you to build a portfolio presumably with lower risk than if you had fewer options available. Simply put, the Prudent Investor realm provides a great deal of additional investment choice, but with that comes some specified governance to make sure that things don't go offside. It provides more potential for growth, whereas a legal list, conceptually, as I have always thought, is designed for the preservation of capital. To go into this a little bit more depth, under the legal list, the municipal council would be responsible for developing an investment policy statement, which the staff and treasurer would then implement. The investment approach, it's all about not picking bad securities, not losing money, not making a mistake in what you buy. It does not attempt to match the municipal needs or the timing of those needs with the investments. It is somewhat one-dimensional in that respect. The risks are controlled on a security-by-security basis, but it does not look at the risk of the total portfolio. The Prudent Investor standard, well, it's going to be a different setup. It's still being built at the moment for investors on the call. We will have it up and running at some point next year. But to give a sense of the differences, again, the municipal council will be responsible for developing an investment policy statement, and one investment and the one GIV would develop an investment plan that helps implement what is appropriate for the community as laid out in the investment policy statement. The key difference is it looks at the total portfolio when evaluating risk and not the individual securities. The emphasis is that what you invest in should meet the long-term needs of the community and the financial needs associated with that. One thing that I think is a key thought process is that investments don't all move together. In fact, they sometimes dance a different dance. And the chart we have on this page just really does characterize that. What we've done is from 1980 to the end of last year, we have identified every period where the equity market drops 5% or more. Those are the green charts, or the green lines. And at the same time, in those same periods, bonds did the opposite thing. They went up. And this is what we talk about, thinking about things in a portfolio context. If you have a portfolio that has some bonds and some equities, and we hit a speed bump in the economy and the stock market goes down, it's often the case that your bonds will compensate. Take the case of the Great Financial Crisis in 2008. Equities, they fell off a cliff. There was a precipitous drop in share prices. People were concerned about the financial markets and the economy. People sold stocks. That fear that was embedded in investor reactions meant that they were actually trying to reduce risk. And in so doing, they tended to buy bonds, which are lower risk securities. It's just a reallocation. And in times of crisis, money tends to move out of equities and into high credit quality bonds. And that's why you have this counteraction. And when looking at investments from this perspective, having a little bit of each when there's an event like this means that you get the diversification benefits. That is one of the key building blocks in how we build portfolios, is to get the benefits of diversification. So not all the securities in your portfolio are doing the same dance and moving in the same direction. Now, the offerings that we have under our program that we contemplate for Prudent, it will encompass what we currently have, the HISA account and the bond portfolio, the equity portfolio and the likes. We will have the similar offerings available for what we currently have, which is all different parts of Canadian exposure. We will be creating new products down the line to expand the opportunity set. We're in the process of building a mandate right now, an investment mandate that provides exposure to global stocks that will, for example, have exposure to like the US and Europe and a meaningful exposure to emerging markets. We are in the process of also building a similar mandate for global fixed income exposure, which again will will have heavy bias towards US and international fixed income instruments, and will open up the opportunity set for types of fixed income investments that currently are just simply not available to municipalities, the likes of high yield, emerging market debt, and especially within the US fixed income market, there's a number of esoteric sub-asset classes, we'll say, that give very specialized exposure in the fixed income markets. So that particular component, with these two, the global stocks and global fixed income, will be core components of the Prudent Investor offering. For the global fixed income, we are contemplating that exposure will be predominantly hedged back to the Canadian dollar. So it should give investment exposure internationally, but we will mitigate the potential impact of currency movements. Later on down the line, we will expand the offering as appropriate and maybe add other asset classes to expand the offering and give more granular choices. Now, in terms of our approach, we have devised a way of framing the discussion. We recognize that on the municipal side, you're not investment experts, and your core job is not the investment bit. It's servicing the municipality in other ways. That is my expertise. That is the expertise of board members that will sit in our joint investment board. And we've figured out a way of trying to translate what the municipalities see as their needs and translating those into a way of investing. So rather than go out to whatever the municipality is and say, okay, how do you want us to invest your monies? You know, I'm sure if we did that, a lot of people would stare back to us and say, I don't know. What we intend to do is use an outcome-based approach where you can describe the accounts you have set up within your municipality for the purposes you set and map them out into one of the outcomes that seems appropriate. Basically, it turns into a conversation. You tell us how you group things and the purpose and what you think about it, and we can just drop it into one of the boxes that seems most appropriate. We're trying to simplify the conversation so you can talk, so the municipalities can talk in the context of what they're familiar with, and we can translate that to an investment plan. And we think that for all the purposes for municipal monies to be invested, that three broad categories of outcomes should be able to cover all the potential investment needs. And these three, as you see on the slide, are a contingency type solution, a stable return solution, and a target date. To go into a little bit more depth, the contingency outcome, you know, I'll refer to this as being sort of like your rainy day fund. There are events that you know might be likely to happen. You might not know when they're going to happen, and you need to plan to deal with them. You know, there could be many examples. You know, the first bullet point really identifies that. I think probably the most relevant one is like weather type events. In Ontario, obviously flooding has been an issue affecting a lot of communities. It's something that you can't plan for in terms of the timing, but I'm sure that the communities where this is relevant, they set some money aside for when events like this happen, they have the funds to deal with it. Again, the rainy day fund. Now, if we know that that's the need, we can set up an investment outcome that matches that need. And the idea is that monies would be deposited and contributed into the Contingency Outcome Fund. The monies would be invested to provide growth. Presumably the growth would be at least the level of inflation plus a little bit, And as the monies grow, the balances in the contingency outcome would grow over time. And at some point, no doubt, there's going to be some hiccup that requires communities to draw down their funds in this outcome. And as you see in the graph, it grows, it drops, and then from that point, the remaining balances in the contingency outcome would again start to grow. It's sort of like a ever-filling glass in that respect. How much you set aside for contingencies and the like, there could be in a community a desire to say, well, once we hit $1 million, that's more than we'll ever possibly need, and could be capped, and money could be flow into other types of outcomes. But this will give you a sense of how it's intended to the pattern of returns. We're expecting the balances to grow, be drawn down, and then grow again. The next outcome, we'll call the stable return outcome, comes under different names. I kind of prefer the float as the best way to describe it. But, legacy fund or endowment model might be appropriate. For some of the communities we've talked to, the example would be hydro assets, where some of them have sold their hydro assets and then put the monies aside, and the income from those assets is used by the municipality in one form or another. And that kind of embraces what the stable return outcome is. Where this differs from the contingency, yes, okay, the monies that are invested in the stable outcome solution would tend to grow over time. The growth that's embedded in these solutions would be, we hope to be at least the level of inflation, perhaps a bit more, but the income produced by these investments, they would be available for payout. So in this graph here, you see that there's a little blue bit. So you don't get the full growth of your assets over time. It's envisioned that some of those monies may be available to fund whatever the needs are in the community. And it's appropriate for a number of needs. If it's like the recurring expenses like repaving the roads or winter snow maintenance, it's going to happen every year. That some money needs to be set aside for it. This just might be an appropriate way of dealing with it. And the last solution or outcome is actually a group of different outcomes, but they fall under the same title. Basically, this is for large, lumpy, discrete budgetary items that you can plan for, and they're large enough that you should plan for. And the example might be a community wants to build an arena 10 years from now, or a hospital 20 years from now. Some or all the monies are available now. What do we do with the funds until they're needed? Well, if we know with a great deal of certainty when the money is needed and how much it is, we can build a portfolio that suits that very well. Conceptually, if you have a long time before your money is needed, you can invest for the long term, which means you can put a higher amount of equity into the investment portfolio and take some risk in the early years. And as you approach the time when you actually need such funds, you would not want to risk losing money, and the allocation to riskier investment types like equity would diminish. So it's if we can identify the projects in the community that are large, lumpy, and discrete, we can build investment outcomes that are basically dovetail with these specific needs. As I say, because there may be different time frames involved, there could be many different target date outcomes, one for that hospital, one for that arena, because they're on different time frames. Now, on our side, the investment policy statements that are drawn up by the municipality will indicate to the asset one investment about how to set out the asset allocations. This is our way of translating it. If a municipality is able or wants to set their own investment allocation, we'll take that advice. We are using the outcomes-based approach because we think it simplifies and resonates, but we are open to other solutions. The asset allocations that we generate either through the outcome-based approach or provided by the municipality, please note that nothing's written in stone. These things can change on a dime, and just as the circumstances in the municipality can change because of, could be political, could be weather, could be a number of events. If things change, we can adjust the way we implement the investments accordingly. On our side, we will have an investment management system set up specifically to monitor the investments that we manage. It will give us an indication of when we need to make any adjustments, and will be checked by the investment manager on a daily basis. Basically, you know that the monies that are invested will be reviewed on an ongoing basis and adjusted accordingly. I think it's important to just maybe state our perspective when we approach investment, and this page discusses what our beliefs are. And first and foremost is that the key thing that we're trying to resolve is matching the timing of the investment need versus the returns. That is to say, you know, you might be able to make 100% return, but if the funds aren't available when you need them, who cares? The idea is to match the timing of the investment returns with the need so that you can have the monies available to pay the bills or build that hospital or build that arena as appropriate. We also recognize that, you know, municipalities are effectively institutional investors, but they're very different than the main institutional investors out there. This is not pension money. This is not money that is invested for a very long period of time with few changes in between when it's deployed and when it's used. We understand that these monies are dictated by operating budgets, and there are moving parts that can change things radically. Monies basically may be needed much more rapidly than would be the case for some larger institutional investors. We believe that asset allocation is the main driver of investment returns. That is to say, the allocation of equities versus fixed income. Getting the right allocation and staying on track is going to be the main driver of overall investment returns. Market timing, we do not believe, is a productive way to add value. Some people are particularly good at it. On average, it's not really the case. It's unlikely to add value, and that's something that One Investment and the JIB will not attempt to do. Some of our underlying managers may make some allocation choices and timing decisions, but that's slightly different. We believe that rebalancing is a key to keep the risks constant, and it also does help to harvest some gains over time. I mean, that's maybe a relevant point. Maybe I'll just expand on that one point a bit more. Rebalancing, and just think in the last 6 to 8 month context. If you, for example, for your portfolio, had set an allocation of 30% equities and the rest fixed income, and you had that allocation, say, last September or October, well, the markets did something really funky last fall. Equities dropped precipitously in the fourth quarter of last year. So if you started with 30% equity, by year end, you were not sitting at 30% equity. You might have been sitting at 26 or 25% equity. Our take is if there's big movements in your allocation, we just bring it back to the target. And had we been investing under this type of a mandate, we would have bought more equities at around Christmas time, near year end. And what has happened since then? The equity markets rebounded. They regained all of their losses from the fourth quarter and then some. Again, if this was if the monies were under us in the way that we intend to do things, it would have meant that you were over allocated to equities at the end of the first quarter and would be compelled to sell. So the rebalancing itself not only keeps the risk constant, it's a way of harvesting some gains as the performance of markets gyrates. We also believe that, of course, that our outcomes are appropriate for the municipal sector and cognizant of the risk levels that are appropriate for the sector. We also realize that what we're starting with was not what will not be constant. We intend to respond to different needs, and the offering will develop over time. Again, to the point about timing the markets, we don't have a crystal ball. We don't know when equity markets are going to go up and go down. Many people on Wall Street, Bay Street seem to imply that they do know these things, or at least have some confidence that they're able to. But studies we have seen that go back into the 1950s show that it's just a very hard game to do consistently. Picking the time to buy equities and picking the right time to sell them, it's very difficult. And again, you go back to that scenario I said last fall. If you were in equities last September, October, what would you have done? Well, if you were listening to the folks on CNBC or Bloomberg and waiting for them for the signal as to whether you should buy more equities or not, I don't think that there was a clear consensus that you should have been reacting before the market plummeted the fourth quarter of last year. What I'm trying to say is timing the markets is very difficult. As the title of this slide says, time in the market is more important than timing the market. If you invest and stay invested long term, odds are you're going to make some money. If you're trying to pick your spots, you're opening yourself up to actually losing money. Now, one of the key things for the Prudent Investor regime is to define the monies not required immediately. Now, there's no clear rule as to how this should be defined. The City of Toronto practice gives us an idea of what may be the most appropriate approach, and they defined it as 18 months. So if the money perceives that the funding is required within the next 12 to 18 months, it gets categorized as short-term money. Any monies, even after you move into the prudent regime, any monies that are designated as required immediately or for short-term needs, those still get managed by the municipality. They still get managed under the legal list procedure. So there's you have a prescribed list of investments you can invest in. Any monies that are designated as not required immediately, and in this example we've used 18 months as the way of earmarking it, those would be turned over to the Joint Investment Board to manage. They would be managed in accordance to the municipality's investment policy statement. The control of those investments is under the realm of the Joint Investment Board. Once you designate those monies, it's the oversight and investment is done for you. Yeah, the council defines the money is not required, and also would typically define what their risk tolerances are through their investment policy statement. As mentioned, the municipality manages the short-term funds under the legal list. If they're invested with us, I mean, we would provide reports in this sort for the one investment returns. The long-term funds managed by the JIB, again, the investment policy statement would direct how these are invested. There's also another documentation, a client questionnaire, which helps inform the investment policy statement. The municipal staff is no longer, they will determine how much money goes to the JIB effectively, but they are no longer responsible for the investment function. Only the monies under the legal list, the short-term monies, stay under the realm of the municipality. We would provide all the documentation and all the reports for the investments under the Prudent Investor offering with us. So just some considerations, some planning issues. I mean, for the municipality, it is your responsibility to define what monies are not required immediately. There is some flexibility in terms of how that is defined. We have defined the best practice as 18 months. There may be circumstances where that may not be appropriate for the municipality. When we get to that stage, it will be a conversation and we can elaborate further. Another thing that has come up that I've noted is that the municipalities tend to be very risk averse. Some believe that investing short term is safe, and they would rather have monies available to meet unexpected needs. Rather, basically, you just want to keep flexibility on the table. That is appropriate, but again, that would be a conversation with us to try to figure out, how much can you invest longer term, and what's the best approach. Now, on slide 23, again, it's touching base on that short-term investing bit. While it may seem a great way of mitigating risk by keeping all your money in short-term investments, you're very unlikely to lose money. There is a bit of a problem with that. And this slide, I'll just direct you to the graph in the table. The blue line showing what has happened with T-bills, very, very short-term investments, basically very little over the time frame 2008 to now, whereas equities have traded all over the map, and bonds is somewhere in between. Now, on the table, you see the average annualized return over that period of time for T-bills has been almost 1%. And the risk, as defined by a standard deviation, is 0.2%. So that is to say, two-thirds of the time, the returns are going to range from 0.7 to 1.1%. So there's not a lot of range of outcomes under that scenario. Whereas bonds have much more volatility in terms of outcomes and much more return. And at the other end, at the top end of the spectrum, is the stocks, which have more return and a lot more risk. Note in this particular example, we've made this a punitive example for equities. We picked 2008 as a starting point, right before the financial crisis. So again, it demonstrates the thought of long-term investing. Even if you invest at the at the wrong time, but you stay invested long-term, you can accept a big bump in the road, a big loss initially, and the growth in equity markets should be sufficient for you to have robust returns over time. The investment horizon is what drives it. So again, where is the risk here? The low-risk solution, T-bills, gives you a return of somewhere in the range of 1%, and it's never going to be more than that. Whereas over this period of time, the winner in terms of performance is stocks. Where's the risk? Is the risk that you don't want to lose money short term, but end up with less money at the end of the day? I think that from our perspective, one of the themes that we want to impress on the municipalities, if they can, and it's appropriate, equities in the portfolio is a good thing. Getting the mix right is appropriate, but we want to move away from just protecting the portfolio from short-term fluctuations so we can get more returns over the long term. Now, in terms of roles and responsibilities, it is the municipality's role to do certain things. The One Investment and the JIB have other responsibilities. Under the municipality's role, they need to adopt all the bylaws involved to move to prudent investing. It is the municipality's responsibility to draft an investment policy statement, which must be updated at least annually, which defines what the long and short-term needs, objectives, and risk tolerances of the municipality are. The JIB and One Investments, we can provide input on that investment policy statement. We can provide advice. We will have a base template to start with for those joining the Prudent Investor regime with us. The ultimate responsibility lies with the municipality. Also, if there's a client questionnaire which need to be updated manually also, which is another piece of documentation that keeps us up to date. And you need to, at least on an annual basis, provide reporting to council on funds under the Prudent regime. For the JIB, it's a different set of responsibilities. The JIB itself is a municipal service board, full clerical responsibilities, public meetings. The roles of the JIB include defining what the principles and beliefs are. They advise on asset allocations. They select managers. They direct the investments such that they meet the needs as stipulated by the municipality in their investment policy statement. Again, if we're using the outcome-based approach, we can map that out using that, or if the community itself has an asset mix that they want us to adhere to, we can use that also. The One Investment Board, it consists of, call it a half dozen investment professionals predominantly. They provide some heavy lifting in terms of direction, but they can't do all the work. They have the authority to delegate to others to provide the services. They will bring in advice from legal counsel. There will be a consultant involved to provide more specialized studies and services. They can hire investment managers, fire investment managers, monitor the managers appropriately. The One Investment side, that would be myself and some of my colleagues who are involved in the implementation of the plan. The scope of our activities are quite wide, but we end up being, I would help implement what the JIB dictates. And there's a number of other things that I can do. I can provide advice to the municipalities either within the Prudent Investor regime or legal list. I can help build transition plans. A lot of municipalities wanting to move to the Prudent regime may have their money in GICs, for example. It should be noted, and I'll say this loud and clear, GICs are very hard to unwind. If you're planning to move into the Prudent regime, you might not want to be buying, 5 and 10-year GICs because your money will be locked up over that time period, and will be difficult to have the monies available to move into some of our investment products if they're so desired. We can help plan how investments are dealt with to mitigate the impact of gains and losses that are realized, which typically flow into your budgets. On an ongoing basis, I will be involved in creating new investment products and monitoring the portfolios, rejigging the asset allocation, ongoing monitoring of the managers and changing them as appropriate. We will also provide regular investment reporting and support the JIB in whatever ways are required. Now, with the way we're going to implement the Prudent Investor regime, we are offering pooled products. We will have basically a range of supporting documentation and supporting bits and pieces to help this all move through. We will have, for example, we will provide a sample of the business case for moving to Prudent Investor that would help support the case. We will provide documentation that could be used, educating counsel, constructing the investment policy statement of the sort. As a CFA, I am available to anyone on the call to provide investment advice. Again, whether it be for in the legal list realm or in the Prudent Investor realm. I have fielded questions from some municipalities saying, we're very small, we don't have a lot of financial institutions nearby. We need investment advice. Can you call us up and then give us a view on this or that? I am available for that. And broadly speaking, we're available to support municipalities with such roles. And we do intend to have ongoing webinars like this, conference sessions, newsletters, educational input to bring up the level of education and knowledge for not just the treasurers and staff, but also for council. We see ourselves as instrumental to bringing the entire municipal sector into a new realm of investment that simply has not been available before. Again, we will have a turnkey solution. Our offering will be fully compliant with all the legislation. We're committed to providing best practices with our offering. We intend to manage the costs and provide a diversified suite of investment products and strategies to meet the needs of the communities that are working with us. I think at that, I will turn it over to questions.
We do have two questions. Does each municipality make their own portfolio?
For the Prudent Investor world, we would build a portfolio for you. So no, that's not the case. So again, the municipality would update a questionnaire and investment policy statement, which again tells us how the municipality's accounts should be invested. And then on my side, on the JIB side, we would use that to develop an investment plan. And that investment plan is going to be a lot more granular and will refer to how things should be invested with more granularity. It might say that for your community, a 10% allocation to equity is appropriate, and it should never exceed 20%, for example. And there would be, typically more parameters in there to delineate how we would actually invest your monies. And from that, we would build a portfolio. So it's a way of taking the instructions that are not formulated in truly investment terms and translate it into a portfolio. So we would take what we're given and formulate that into an investment portfolio for you. And that would be using the components we have on hand, our pooled investment vehicles in different proportions to satisfy that particular need.
Second question: What is your outlook for the impact of cryptocurrency?
Honestly, I don't see that. I mean, I'm biased. I'm old-fashioned. I've been in the industry for well over 20 years. I don't see cryptocurrency as an investment. It's basically, there's been a lot of speculation in relation to cryptocurrencies. There's been a lot of excitement. As an investment product, I kind of scratch my head. I don't doubt that there may be some staying power in terms of these cryptocurrencies, but whether one can make money or how one would make money in a consistent way, I just don't understand. With equities, it's pretty clear. You invest in equities, generally speaking, because there's an underlying business that makes money. And if that business makes a lot of money, the investors make money too. I can't build a similar construct with Bitcoin. So I personally I've struggled with all the excitement in cryptocurrencies because it's just hard to justify. It seems more speculative in nature. I mean, do note that in the Prudent Investor world, I'm not going to preclude the possibility that esoteric asset types might be in the mix. I suspect Bitcoin or Bitcurrency would not be involved in the mix, but you can't preclude it. And there's some ability, if there is some esoteric investment product that will help the investment portfolios, we can put them in small portions. And we do contemplate putting different bits and pieces in there, whether it be exposure to real estate, infrastructure. There's a whole bunch of different products that we can build into these mandates. I believe we'll circle back on that at a much later date, because the more granularity that we build in terms of products, it'll just take some time. Especially, it's nice to have economies of scale. So if you have a lot of money, you can lower the cost of investing for everyone involved. So we're going to work on the core products first, and then as time goes on, we'll identify other types of more esoteric exposure that might be beneficial. But yeah, you can correct me on this in the future. I would be surprised if Bitcoin is on that list. Again, thank you very much for joining us. We're very excited about the Prudent Investor regime and all the movement there. This is one of the most, as far as I'm concerned, one of the most exciting things happening in the municipal sector right now. And it is brand new territory. It's something I personally am very excited to be involved with. And I'm sure that we will field lots of questions on this front because it's new for everyone involved. So don't hesitate to reach out to us with questions after the call as appropriate, and we'd be glad to get back to you. Thank you very much for joining us today.